I don't have any slides, so I'm just going to share some of my thoughts with you and then hopefully open it up to some questions. Yes, I was a pioneer, or am a pioneer, which means that, as they say in English, the pioneers are the ones with the arrows in their backs. And it means that you do make a lot of mistakes. I got into Cleantech Venture Capital actually at the end of 1999. I was working at corporate M&A, one of the European corporates, running their M&A, and got a phone call from a headhunter, which isn't that unusual, but it was just coming off, or I was just coming off a phase of 10 years of restructuring one of the European industrial technology companies. And so I was a bit open to listening to new ideas, and this guy said, how would you like to join a startup asset management company and start up their venture capital activities? And I thought, how difficult can that be, right? I had actually no idea that what I was doing was going to be the first clean tech fund in Europe. Actually, we didn't even call it clean tech back then. We called it sustainability, which made fundraising even more difficult. So that phone call was really the beginning of Emerald Technology Ventures, and it has been anything but easy, but I have to say it has been really, truly rewarding, and we have learned a lot over the last 10 years. Which means that obviously we've made a lot of mistakes. And 10 years is a great, let's say, time period to look back on and say, okay, what was really going on and how has this sector actually changed over the past 10 years? The first one has to do with knowing when capital intensity is just simply too intense. The second one is when is the leading edge actually leading into the bleeding edge? And the third one is really about backing the best people. And with each one of these, I'd like to then touch on how has the role, or at least our understanding of the role of a successful clean tech venture capital actually changed over the past 10 years. So moving on to capital intensity, there's, let's say, three areas. One is obviously when too much money is going in, then you expect to get out. The other one talks about really exits, and that has already been mentioned a bit. And the third one is about simply the capacity of venture capital in Europe, and I think that we should spend a bit of time talking about that. The issue first going to about how much money goes in compared to how much money can go out. Clean tech is often kind of given the negative blanket judgment that, this is simply too capital intensive. You can't make VC returns, and so just forget it. And I think that is really short-sighted, and one has to really differentiate. There are definitely business plans that we receive, which you just say, I don't see how we're ever going to make money if we invest in this company. And sometimes it has to do with the capital expenditures that are associated with that business plan. And sometimes it just happens to deal with the accumulated losses over the years. And often, entrepreneurs are by nature extremely optimistic. Let's face it, if they weren't extremely optimistic, they would not have quit their job somewhere else and started up a company where they could end up in bankruptcy, potentially. So I think that's really important, that we challenge these entrepreneurs about how can they come up with better business models, and how can they rearrange their scope of supply, how can they rearrange their outsourcing. The other topic is about the exits, and often if you do see a business plan which requires a lot of capital, and that in order for them to truly be successful and to reach a sustainable self-financing situation, that they're going to need to kind of be passed on into the public markets and let the public markets finance that, or they're going to go to a new home and be within a corporate. What we have realized over the years, if you think the last 10 years, there have been two periods where IPO market basically shut down. So going into a deal, you cannot simply count on the public markets being there when it's time for you in your plans to move it on to the public markets and raise substantial amounts of money to finance a business plan there. The other one has to do with the corporates. The corporates aren't always just standing there ready to buy these companies. Right now we are I think it's a very positive development where you see a lot of the corporates who in the early 2000, 2001, 2002 period, they were all coming up with their sustainability reports, and lots of PR was going on about sustainability. That has really changed a lot. I mean, in the past 10 years, that sustainability, white, kind of greenwashing, if you'd like, has moved into the operating units, has moved into their strategies, and has moved into the M&A departments. And now we're getting actually a lot of corporates who are deploying significant amounts of money or have plans to deploy significant amounts of money in clean tech and buying new technologies and buying startup companies. But we have to see corporates don't like to buy loss-making companies, right? It is really, really a daring corporate executive who's going to go out and basically risk his career to support an acquisition or to champion an acquisition of a highly loss-making company. Unless he can really integrate it and nobody else within the corporate can actually see whether it's still loss-making or not, most of the time they're actually quite risk-averse. And so I think we have to be realistic from the VC point of view that we need to bring these companies typically at least to just barely break even before the large corporates will be much more open to actually buying these companies. The third aspect is really this issue of the capacity of the European VC market, and Robert mentioned that before. And if you looked at those numbers, there was, I think, two really, really interesting numbers. And that was the number of companies and the amount of money that's invested in those companies. And you have huge, huge disparity between North America and Europe. In Europe, I think we've come a long way, obviously, in 2000, where it was difficult to even think about raising 10 billion euro over the life of a startup. Today, in Europe, I personally would be extremely nervous about backing a company that needed to raise more than 40 to 50 million. And that's pretty low. If you think that, think what you like about some of these California clean tech companies, but if you think of a Bloom Energy that's, in a fuel cell space has raised 400 million. If you think of Tesla, which is kind of the California poster child of clean tech, pre-IPO raised almost $800 million. In Europe, I don't care how interesting the technology is, I don't care how promising it is, there's no way that we are going to get into that kind of financing risk. Europe simply does not have the capacity to support those kind of financing rounds. There's a lot of reasons. I can go in, that could be a whole nother topic, but I believe it has to do with the lack of institutional investor support in Europe, primarily the public pension funds. Whereas in the US, you've got a lot of public pension funds pouring huge amounts of money into the North American clean tech funds, and so therefore they have more money to deploy. In Europe, it's very, very restrictive, and as was kind of alluded to, and I guess was a topic yesterday as well, many of the institutional investors in Europe are also kind of restricting their funds to doing late-stage deals as well. So as far as kind of from the role of the VC, I think that relating to capital intensity, I think that there are really creative business models that one could introduce into the portfolio companies, and a lot of it has to do with working with corporates. The corporates have huge infrastructures. Clean tech is really a transition, if you'd like, of a lot of huge existing industries. It means you've got huge existing players sitting on the channels to those customers, and really marrying the two, bringing your startup companies to work together with the corporates is a lot smarter, and it wasn't done typically in the past in other venture capital sectors in the IT that wasn't really the model. And I think that slowly but surely the clean tech VCs are realizing that the corporates are not their enemies. The corporates are actually a lever, if you like. And so I think that the VCs need to be building much, much stronger relationships with the corporates and to enable some of these businesses to actually structure more capital light, if you like, business models. Now moving on a bit to this concept of the bleeding edge. There again are kind of three aspects. There's the issue of market insight and understanding your markets. It's also understanding customer processes and the true realistic technology adoption rate. And the third one has to do with public policy and how quickly will these markets actually become real. On the profound insight, I think the VCs by nature, we like new things, we like to have insight, and we like to think that we know what's the next latest and greatest thing. And that sometimes can actually bite you because, we meet these young companies, these entrepreneurs, and they can sometimes show us some signs that, they're in discussions with corporates, that contracts just around the corner, these utilities are really excited about their technology. And sometimes because we want to believe them, we will then misinterpret signs of really just early adopters kind of sniffing around and thinking that something might be cool and interesting. And we misinterpret that as thinking, okay, now the market's ready. Now it's actually going to be rolled out, and this is going to become a massive market, and we're going to be the first ones there. Actually, you don't need to be the first one there. There's typically further financing rounds which give you the opportunity. But again, to understand these customers, we as the VCs, that's again kind of the role of the VC. It's not just taking the information from the entrepreneur, but it's really having built up very strong relationships with these utilities over the years, and I'm just using utilities as one example, but obviously there are other customer groups. But really knowing these guys and being able to pick up the phone and call them and say, what is really your plan with this technology? Are you guys just sniffing around? Is it just something cool? And there are great kind of spirits out there who, individuals who we know at certain utilities will look at anything. They have no intention of actually making a major rollout. They just think it's really exciting. They think it's a fun part of their job that they get to technology scout. And it's up to us as VCs to bring that dose of reality, if you'd like, into the business plan and to say, look, I talked to the guy. Sure, he's really excited about it, but he has either no ability or nor interest, or it's going to take forever. So again, it's up to us as VCs to have those relationships, to be able to bring that reality into the picture. The other thing about the customer processes, there are certification processes which can sometimes take, we had one of our portfolio companies, they thought, okay, we can get this certified within, 1-2 months, and then we'll go into, commercialization, then we'll roll out, and next year we'll have sales of 50 million. It took them 3 years to get their certification. And we financed the company for 3 years while they were getting their certification. Now, obviously, we knew that it was going to take longer than 2 to 3 months, but we also had no idea it was going to take 3 years. So I think that that's really important, is to understand for each one of these technologies, sometimes by application area, by geography, these certification processes can be really extreme. The other thing is, what is the actual let's say internally within the customers, what is their internal certification process? So aside from the governmental agencies, what is it going to take for them to actually put the stamp of approval and say, okay, now within a Dow Chemical, within an Eon or whatever, this technology can actually be adopted and applied? What is the piloting process? How long is that going to take? And what is realistic to expect as far as the technology rollout?